Welcome, everybody. My name is Tom Gordon. I'm with the Brunswick County Literacy Council, and today we're part of the team that's bringing you the FDIC Money Smart financial education program. To tell you a little bit about myself, I have 20 years with one of the major credit bureaus, which is focused on credit reporting, credit lending, and then I ran a risk practice for one of the major bank payments companies that monitored banks for issues and fraud and crime with regard to deposits, money laundering, wire fraud, check fraud, ATM fraud, and I did that for the top 200 banks in the world. And then now I'm an executive recruiter for the fintech, specialty finance, and payments industries. So companies like Venmo and Zelle and PayPal, Cash are all the types of companies that I recruit for today. So today we're going to, let's recap a little from the last course you're in, which was Charge It Right. So there you covered the purpose of credit cards. I'll just give little reminders. Credit cards are for convenience and for emergencies. We'll talk later on about what happens if you use it further than that. Where you can go and apply for a credit card. Pretty much where you bank today is where most people start, whether it's a bank or a credit union. Most of them offer a credit card. They know you, they already have a relationship with you, and they know how you behave on those relationships. So they're a good place to start. How to decide which credit card is best for you, or if a credit card is a good idea for you at this time. Most of you, depending on your age, are going to be new to credit. You need to be 18 to have a credit card. You're still new to credit. So one of the things, then we'll talk about this later with installment loans, is to kind of look at what your credit history's been and how you've paid other credit grantors. You may not have any. And so you're what they would call too new to credit. So you have a thin file or no credit file with the credit bureaus, and you have really no credit score. It takes a couple of years of history before FICO and the credit bureaus will assign you a score that's used in the marketplace. So most banks have a student credit card program where they give you a smaller limit, and they kind of let you ease your way into working with credit cards through your time at college, and then maybe coming out, then you start to look at more advanced credit cards. If you are uncomfortable with having a credit card where you might go beyond just using it for emergency and might be tempted to use it for regular everyday use, if you don't pay within 30 days, it becomes a loan, which must be paid back. And if you don't, or if you're late, that shows up on your credit report and lowers your credit score. So you kind of need to know when you're ready to take on debt in your world. What credit card companies look for before they issue a card. Again, they're looking for the credit history. They're looking for your income. Can you afford the card? And with regard to how you use the credit card responsibly, safeguard against identity theft. Are you paying your card on time? You want to make sure you know where your card is. If with regard to safeguard against identity theft, your credit card issuer is not going to call you and ask you for your account number, your bank information, your personal information, your social security number, none of that. They don't do that. Fraudsters and criminals do that to steal your identity. Your bank will tell you to call them, and then you can verify that you're actually talking to them before any of that information is released. So today we're going to talk about paying for college and cars. So we're going to be talking about the difference between secured and unsecured installment loans. So we're moving away from the credit card now to a different type of lending. We're going to identify the factors lenders use to make a loan decision. We're going to break it down even further. And we're going to identify the questions to ask when purchasing a car and describe the various types of federal and private college financial assistance programs that are available to you. Installment loans is money that you borrow and repay, and typically they're in fixed monthly payments. So if it could be that you get a 5-year loan and you're $225 a month, include principal and interest, and that stays that way for the full 5 years. And it's usually set over a period of time, 5 years or 2 years, whatever you took the loan amount for and the time for. There are two types of installment loans. One is secured and the other is unsecured. A secured loan, you offer collateral to the lender if the loan is not paid back. Collateral is an asset, it's something that you own. If you get a car loan and you don't pay full cash for it, you're almost always offering the car as collateral for the loan. If for some reason you cannot pay for the loan, the lender has a lien on that title and can repossess your car. That's how, because that's their security, why they call it a secured loan against being repaid. The unsecured loan is not secured by collateral. Consider this where you would go for an emergency in life. If you have your car breaks down, you have an unexpected medical emergency, someone dies in your family, your hot water heater breaks. There's so many things that can happen in real life that you may not have the cash in your deposit account, your checking account, savings account to cover, and you need some cash right away. You go to one of these companies that makes unsecured loans. If you're not offering collateral, you're going to pay a premium. You're going to pay higher fees, and you're going to pay very, very high interest rates. This is the kind of loan you use in an emergency. As soon as you can, pay it back, move on. Don't create a long-lasting relationship with an unsecured lender. It doesn't really work out for anyone in the long run. So consider that an emergency situation. There's some basic terms with regard to cost of an installment loan. The APR is the annual percentage rate. It's the interest that's charged for that loan over 1 year. A fixed rate loan has the same interest rate for the entire length of the loan. A variable rate loan is going to tie the interest rate to some type of index, whether it's the prime rate or a T-bill or something that's published every single day. And if it goes up and down, your interest on your loan goes up and down. So you kind of want to think about a variable rate loan pretty hard before you accept one, because it's really hard to forecast the market and where those indexes are going to go. Let's talk about finance charge, or really just all the charges related to getting a loan, except for the principal itself. We have a student question on finance charges. A finance charge, what is a finance charge? Because you hear that word all the time, finance, but with regard to a loan, what does it mean? So it's the total amount of interest and loan charges you would pay over the entire life of the loan. For example, they can include origination charges, all the work and paperwork and files and credit reports and things that goes into originating that loan. For as long as I can remember, the 4 C's have kind of been a staple in evaluating creditworthiness of the consumer: capacity, collateral, capital, and character. Let's kind of break those down. The first C is character. It's reflected by the applicant's credit history. As we just discussed, you guys are, for the most part, fairly, if you have credit, you're new to it. If you don't have credit, you're really new to it. But as you get your first, say, credit card or maybe your car loan, that credit grantor for your car loan, that bank, that car dealership, the bank issuing you a credit card, at the end of every month, they're going to report to the 3 major credit bureaus how you paid. Did you pay on time or were you late? And this gets loaded to your credit files 24/7. So you can start to build a credit file fairly quickly, and this starts to create a history. Again, when you're new, they're going to know you're new, and they'll look for a thin file or not too much there. But once you get one started, all your behavior in the very first one and every one thereafter, every loan thereafter, create your history, which will last basically your entire adult life. The three major credit bureaus, you probably know their names, are Experian, TransUnion, and Equifax. The second C is capacity, particularly here when we're talking about car loans. It's the applicant's debt to income ratio. You don't want to have more in debt than you make in income. They'll check that ratio. It's very possible you just simply will not get the loan. If you do, then the fees and interest will be very high, and there'll be very tight limits on how they administer that loan with you. The third C is capital. It's the amount of money an applicant has. So they'll ask you to report your income on the application, and they may ask for your bank account information. You want to make sure you have money to pay for the loan that they're about to make. The fourth C is collateral. We've discussed that already. It's an asset that can back the security of the loan that becomes the possession of the lender if you do not repay the loan. Here's another student question. What things can you do to keep a good credit rating so that you can get a car loan or a student loan? A credit rating is the same as your credit score. So we went over this a little bit. I'm going to go over a little more detail. Pay your loans and credit cards on time or as agreed. Check your credit file once a year. You can go to annualcreditreport.com, and it's free for all three credit bureaus. You can go to, most banks offer a look at your credit file and your credit score free. You can go to apps and places like Credit Karma. There, you can always take a look at your credit report there. So it's become ubiquitous. It's not hard to find your credit report. So if you're getting ready, check it once a year. But if you're getting ready to buy a car or apply for a credit card or get a mortgage, go ahead and check your credit file once again. If anything looks funny or weird or not what you were expecting, that's the time to challenge it, not after you're already in front of the auto lender and he's telling you you've got a problem with your credit report. You can make sure that doesn't happen. My recommendation is to start with a low limit credit card. Ask your bank or a credit card issuer to do that, maybe $500, maybe $1,000. Borrow a small amount against that and then pay it back within 30 days. They want to see that you can manage debt responsibly. So you don't, if you pay it always within the first 30 days and you never use the loan portion, they really are not sure how you would handle debt. So I would use it sometimes and then pay it back right away. I wouldn't apply for a car loan or a credit card too many times. It can create hard inquiries which lower your credit score. Foreign language, what's a hard inquiry? Every time you apply for credit and they check your credit file, that date and their number appears on your credit file. And a hard inquiry is really kind of a negative thing if there are too many. It can look for someone who's shopping for credit or maybe who's desperate for credit, and it can eventually lower your credit score. So if you're looking for a car and you go to 10 car dealers and they take your driver's license and your name and address and phone number and walk away, they may be pulling your credit file. And if they do it 5 times, that's 5 inquiries in one day. I would not be too eager to have them go back with that. I would ask them what they're going to do if they're going to pull your credit file, because they want to know sometimes if it's worth their time to spend with you. So they want to check your credit about as soon as you walk into the showroom. Ask them if they're going to pull your credit, and if they are going to pull your credit file, ask if they place a hard inquiry on your report. If they do, you might say, let's get further along in the discussion before you do that. And that's true really with any type of loan. Credit cards are the same. Again, know your credit score and how to keep it high. Pay on time. Create a nice long history to show that you can pay over a long period of time. And I would also make sure you watch your credit file and your behavior on a day-to-day basis. If even shopping for credit can affect your score. This is me. I would limit your credit cards to 1 or 2. 1 for everyday use and 1 for an emergency, or if you lose one. The reason, as a credit counselor, this is kind of what I recommend to people. Here's what happens. You get your first credit card. In the entire world of credit card grantors want to give you a credit card. They will give you a 0 interest rate balance transfer. They will give you, we have better rewards programs. You will hear a million marketing pitches, and a lot of people start to take those cards and take those cards. And then all of a sudden they have more cards than they can keep up with, or they take all those cards to the maximum credit limit, and then they have more debt than they can ever get out of. But I guess another thing to worry about here is your credit history depends on how long you've had credit. So if you look at the last bullet here, you don't want to open and close your credit cards too often. You need to show a history of good payment. So if you have one card and you keep it 25 years, that's a really long, nice history of good payment. Rather than 12 cards, you only kept 1 year. That doesn't show a very long history. For car loans, all lending for banks, credit unions, almost any lending in the United States that's legal is governed by the Fair Credit Reporting Act. And that states very clearly what your credit file can be used for. It can be used to grant credit. It can be used to get a job. It can be used to apply for insurance. That's pretty much it. It's very narrowly focused, very narrowly used, very highly regulated, what they call personal credit information and PII, personal identifiable information. The regulator is the Federal Trade Commission. So that's a good source if you need to get more information on what is allowable by law to be used when granting credit. And again, to get a loan, you need to be 18 years old. Many of you are getting there soon. You've probably heard this, other people talk about it, maybe yourself already. Should I lease a car or get a loan for a car? You should think about a number of things. How long do you plan to keep the car? If you like to get a new car every couple of years, you might want to consider a lease. If you plan to keep it for 10 years, maybe the lease is not your best option. If you would like to own the car after you pay off a loan, then you have to go for the car loan route. So you have equity or an asset that you actually own. Wear and tear, that's a lease issue. They kind of tell you what normal wear and tear is. And you're kind of subject to their rules. Monthly payments on a lease are generally lower than a car loan. Mileage limitations come from leasing a car. They give you an allowance of miles, and if you go over it, they charge you very steeply. Auto insurance, they'll pretty much mandate what kind of auto insurance they expect you to have. And now let's look at the cost and benefits between car loan and a car lease. So we've got a student question here. Is it better financially to buy or lease a car? The answer is it depends. Are you getting a car for a few years for work? If you're using it for work, it's a business cost of business. You can write that mileage off your taxes. Think of jobs like real estate agents, people who drive people in their cars. Maybe you're an Uber driver, and you do want to change out your car every couple of years. Maybe leasing is a better option for you. If you want to keep your car for more than 10 years and you want to own that car free and clear when the loan is paid, then you want to buy. Let's dig a little deeper on this question. So on the left are some potential benefits of leasing a car. You got a lower down payment. You have lower monthly payments available. Your repairs, if you buy a brand new lease, if you get a new lease car, you're not buying it, then it's usually under warranty. So the repair costs are low. There's no selling involved because you didn't buy anything. And you have possible option of a new car every few years. Most leases are for 2 or 3 years. At the end of the 2 or 3 years, you can release the car or purchase the car or give it back. If you release the car or give it back, you still have to come up with a down payment all over again to get a new car. Potential benefits of buying a car. You will eventually, as soon as you pay the loan off, you own the car. You have equity, which gives you trade-in or sales value to buy a new car. You can modify the car without fearing of breaking the lease contract. If you want to put a rack on top, that's fine. It's your business. It's your car. There are no mileage limits when you're paying for a car, and you can sell the car anytime after you pay it off, as opposed to being bound by the lease term. So there's pros and cons and benefits to both. You have to decide what's right for you. I'll make a little more comment. I'm looking into the future here a little bit, but to be honest, and I think you've heard this, once you buy a car and get a loan for a car, whether you pay cash or whether you've got a loan, your car starts appreciating the second you drive it off the lot, and every year thereafter. So it's going down in value. So some people are starting to look at transportation and cars and how much they really need a car and reevaluating the lease option, or do they even need a car? So if you live in an urban area and they have rideshare products or Uber or Lyft or things like that, you may rethink whether you need to buy a car or even lease a car. You could just rent a car when you need it. So I think this is being reevaluated as technology and access to transportation changes. Getting a car and financing a car is about the same thing. The car is the collateral, the lender holds the title, and the amount you pay depends on the price, annual percentage rate of interest, and the length of the loan. But you guys, when all the time on the radio or on TV, someone's telling you, we have a great deal for you, come in, and for $225 a month, you can drive away in a brand new, whatever kind of car. And this example, they're offering for $225. Say you need 5 years to pay, 60 months to pay for the loan, or 5 years. Your total payments are $13,500. That's never really the total cost of walking out the door with the car. So really, it's your total payments of $13,500. They may require a big down payment to get that deal, so that's $2,500. There's always tax and registration. Now the $13,500 is turned into $16,575, over $3,000 more to walk out with a car. Not exactly what you heard on the radio. Just be aware of marketing versus the realities of all the expenses around buying a car. Where can you get a car loan? Most banks will offer a car loan, your credit union. There are finance companies, and then there are car dealerships. Financing through banks and credit unions, there are a lot of positives for this. It's an institution where if you use your bank, where you already have an account, they know you, they know how you behave with them. And banks believe in something called stickiness. So if you have one account, you're not so sticky, maybe just a checking account. If you have a checking and a savings, you're more sticky and likely to keep you longer as a loyal customer. If you have those two plus a car loan, you become much more sticky. The same would be true with a mortgage. So they're looking to add those relationships with you. Go there first. No matter what, shop it around. You have time. Check another bank or a credit union or two and see what they say. You never know. You might be surprised and get a better deal. You can get pre-approval at a bank or credit union, take that with you to a dealer. It's not required to get a loan, but it doesn't hurt. Financing a car through a dealer, often when they're advertising a promotion, you hear the rate for a particular car in a marketing advertisement. When you get there, you may end up having to make that large down payment. They may want you to have a short-term loan, maybe 3 years or less. You may not can afford a 3-year loan. You may need a 5-year loan or 4-year loan, which makes it almost impossible for you to accept the deal that you heard. You still have to have an excellent credit history, and you have to pay a participation fee. A participation fee just sounds like nothing, right? And it kind of is until you break it down. So there's some normal participation fees, title and registration, sales tax, of course. Destination fee is getting the car from the factory to the dealer. And then there's some fees that you might be able to negotiate. Dealer prep fee, getting the car ready for you to pick it up and drive it home. Additional destination or transportation fees. They might have to move the car from a dealership across the street to town to your dealer. They're always going to try to sell you an extended warranty. If it's a used car, that might make sense for you. If it's a brand new car, scratch your head and think about it, because you have to write the check right then and there if you want to extend the warranty beyond the 4 or 5 years you already may be getting. They've some other things like VIN etching. VIN is your vehicle identification number. If you want to be able to ID your car if it gets stolen, you can have that etched on the glass of the car, engine block, somewhere permanent where they can identify it back to you. Credit insurance. If something happens to your car before you have paid it off, or maybe if something happens to you before you've paid it off, you can buy credit insurance that will go ahead and pay off the loan. Those things are in large part pretty negotiable in the dealership. So I know it looks like a whole lot of stuff, but go ahead and be aware of it now when you see it. Otherwise, if you walk in and you don't know these things and they come up with these things, you don't know, should I get that or not get that? At least you have an idea of where you can negotiate and things that you probably can't negotiate. Car dealers, in large part, already have relationships with lenders. You don't have to, once they get you looking at a car and you're seated in the chair across the table, you really don't have to leave there to get a loan for your car. But you can pause and go to your own bank and shop it around and see what's best for you. But they're happy to close the entire transaction while you're there. So normally they have a relationship with about 20 different lenders, some of which lend to prime borrowers, while others specialize in subprime. Going back to that credit score, all three credit bureaus create a credit score. And there's a third party that creates kind of one we've all heard of, probably, called the FICO score. FICO score probably runs 300 to 850, and 650 and below is a subprime credit score. And you see that right here. Subprime credit scores, consumers, shoppers, car buyers are going to pay the highest interest with the highest fees, because those subprime lenders with those low scores really don't have a lot of choice. So you really want to work hard to have a good credit score. So a good credit score is above 650 to 850. And the higher the score, the less interest you pay and the better terms you get for that car loan. So I'm introducing some new terms, but you'll be hearing this a lot in your life, particularly as you start to purchase cars and houses and things of that type. So I think it's good for you to know. The types of relationships that the dealer can have are with banks, finance companies, even credit unions. And many of these lenders, though, only make an indirect loan when they're working with a car dealer. That means you're only dealing with a car dealer and not the bank or credit union. I personally recommend you deal directly with the lender and not through a third party who is not the one servicing your loan. So just be aware of that and ask those questions when they're offering one of their lender partnerships to see if that's a direct or an indirect loan. Exchange for setting up the loan. Many lenders allow the dealers to mark up the interest rate and make a profit on the difference. You're really paying interest on your interest. It's called a reserve, a finance reserve. Most cap it at 2.5%. Others can go much higher. This can result in a conflict of interest. Make sure you're asking that question when you're talking about a particular lender with a car dealer. The car title loan is normally something that comes up after you already own a car. And here we are in the emergency situation again, like we were with the unsecured loan. And you need cash now. And you don't have it in your deposit account, savings account, a relative, someone, a close friend, someone that can lend it to you. And you need cash right now. So you go to one of these auto car lenders, car title loans, and they will give you cash quickly, but in return, you're going to hand them your car title, and you're going to pay the highest possible rates of interest rates for that loan. And the term is going to be very, very short, typically 30 days. Well, if you couldn't pay for the emergency today, you're unlikely to be in a different position in 30 days from now. Oh, well, they're happy to give you another loan. They'll just roll it over for another 30 days with fees and more interest. And what can happen, the more of those rollovers that you have, you start to build a mountain of debt. You're head over heels in it. There's no way out of that. You don't have a car anymore because the lender repossessed your car. This again, this is the lender of last resort for you. We're moving on to paying for college. We've got another little cartoon. We've got two guys here who are getting ready to go to college. They're getting their finances set up. One who thinks he's going to need scholarships, so he's working on his grades because most scholarships are merit. And then the other guy is an athlete, and he's getting a soccer or scholarship to his college, so he doesn't feel the pressure of the other guy. And the other guy feels so pressured because the college is so high these days, I may even need to get a loan. He may need a scholarship and a loan. The point of this cartoon is to show you everybody's situation is different. And in a few minutes, we're going to talk about, there's a lot of ways that you can fund college. Look at them all, tailor the one that works for you. It's not a one-size-fits-all deal. We're going to look at the federal programs first. This is federal government, really means the Department of Education. You can get grants, they call them Pell Grants. We'll go over a number of Pell Grants today. You can get a loan from the federal government. You can go through a federal college work-study program at your school. To get into a loan, a Pell Grant, work-study, you have to fill out the free application for federal student aid, the FAFSA. This is available online. This is available at every college you would apply to or attend. You must complete it, and this is what they use to determine what kind of federal aid you may be able to achieve. If you are dependent and you're still living with your parent or a guardian, and they're probably going to want them to fill out a FAFSA form too. They'll get their own ID because the combination of your situation and your parents' financial situation, they come up with an expected family contribution. That kind of says how much student aid you could get from the federal government. In some cases, none, and in some cases, quite a bit. So it's really going to depend on this form. It's critical. This is the key to the entire program. This is something you want to get at early. This is online. Read the instructions. It's filed electronically. You're going to need, if you have a job, if you've been paid for a job of any kind, except babysitting or errands and stuff, but if you've had a job with an employer, you have paid taxes. Even if it's not complicated, you maybe use TurboTax or something to file your tax returns, you have them. There will be other forms. The same would be true for your parents or guardian. They would, and applying for their FAFSA, they would need to surrender the same information. That's how they determine the family contribution to your financial aid. Different types of grants. Pell Grants are federal grants that are based on financial need, and they're given to undergraduate students. The Federal Supplemental Education Opportunity Grant, this is for extreme hardship. This money is given from the federal government, Department of Education, in lump sum to your college. Then the financial aid department of the college will then make the grants to each student on a student-by-student basis. You're giving them so much money per year. Once that money's gone, that's it. That's all they can do until the following year when they get additional funding again. There's a TEACH grant, teacher education assistance. These are for students who are going to go into teaching. And if they agree to teach a high demand course, and they agree to do that in a low income geography, then they're potentially eligible for a TEACH grant. Then there's an Iraq and Afghanistan service grant. If your parent or guardian was killed in the Iraq-Afghanistan war, you may be eligible for a service grant. So there's lots of different types of federal grants. Grants are monies that you do not have to pay back. Odds are you will never find enough grant money from the federal government to pay for your whole college education. So it probably has to be supplemented, if not by your family and yourself and your own working, some other things. So we're going to continue with federal programs. We're going to look at their loans. Again, like anything else, do your homework, ask questions, compare loans. Same form to start it off with. The FAFSA is required for loans as well. So the federal loan programs, they're direct loans. Again, the lender is the Department of Education. There's a direct subsidized loan. This is based on need. It's for undergraduates. In large part, there's no interest. The government covers the interest on a subsidized loan. An unsubsidized loan does not require hardship, and it does require probably a credit check, and there is interest with an unsubsidized loan. The plus loans are for people who've already graduated with undergraduate degree. They're going on for further education, certificates, different degrees. You've gotten your undergraduate degree behind you. It's called a plus loan. Here, they are going to check your credit report, and they're going to basically be giving you money to further your education. That's why they call it a plus loan. And there is an interest-bearing loan as well. As you go through 4 years of college or more, you could accumulate a lot of different types of loans. So something to consider, and that becomes hard. If you have a lot of different types of loans, that gets hard to manage. Who's my servicer? Who do I owe what? How do I keep control of it? You can go and have those loans consolidated by the federal government. So you have one lender, one payment, one servicer. The servicer is the company that manages the loan, the payments, and all the paperwork that is around that loan is called servicing the loan. And if you're only having to deal with one, it's a whole lot easier than many, many, many servicers on your loans. Repaying your federal loan after you graduate, leave school, or drop out. If you drop below half-time, that's kind of considered leaving. You do have a grace period before you have to repay the loan. The grace period varies by loan type and your situation. You know what that grace period is at the time you take the loan. It is not a surprise at the end after graduation. Managing your student loan payments. This is all about having more than one loan, where you probably want to get a repayment plan that is consolidated and makes sense for you. And they offer that, and you can look at all these different options by visiting Department of Education National Student Loan Data System. Has all the information regarding working out your repayment plan. Not everything is federal government. There are non-federal loans. You can get a student loan from your bank or credit union. They often have higher interest rates and loan fees. They will usually require a credit check, and they will not provide all the benefits of a federal student loan. But if you can't get all the monies you need for college from the federal systems, then you might have to look at the private sector, and your bank and credit union might be a good source for you to check out. Here's a student question. Can you apply for and receive both federal student loans and federal grants? The answer to that is yes, but all your student aid added together, can't be more than the cost of your attendance at your college or career school. So if you get a grant, let your financial aid office know you've got that. They'll subtract that amount from your total cost of attending their school, and the balance is what you can receive in terms of further student financial aid. Again, you just can't get more aid than you need to pay for your college education. You can also do a work-study program. This is sponsored by the federal government. These are part-time jobs for undergraduate or graduate school. It's usually with your school. It could be with a private nonprofit or a public agency, but they'll kind of arrange for part-time work for you to help pay for your college education. Kind of moving back to the private sector. We haven't talked about this yet, but there are scholarships. Like a grant, you don't have to pay a scholarship back. It's a gift. There are thousands of scholarships. They're offered by schools, employers, individuals, private companies, nonprofits, communities, religious groups, professional and social organizations. Sounds like a lot, and it is, but how do you find them? So one way is to contact the financial aid office at the school that you plan on attending. You can get some information even at a public library or online. But you need to be careful around this. Make sure the scholarship information and offers you receive are legitimate. If someone is asking you to pay them to find you a scholarship, you shouldn't be doing that. You shouldn't have to pay to find a scholarship. So if anything looks a little odd to you and your antenna goes up, contact the Federal Trade Commission website to avoid scams. Does a scholarship affect my other student aid? It does. It's rolled into everything. So the cost of your student aid is all added together. Even with scholarships now added, it still can't be more than the cost of attending your school. It's like a car. College costs have a lot of components to them. There's tuition, there's books, there's fees, there's housing. Most college websites offer a cost of college calculator. You add in all your particular information they ask for. They will calculate what it costs to go to their college probably the year prior, which is probably a very good approximation of what it costs to go to their school next year for you. So those are readily available. Strongly suggest that you use them. We're back to our two guys again. So the person who had the athletic scholarship, his parents have kind of notified him that college costs a lot more than just tuition. And his buddy goes, yeah, you're right. There's food, there's housing, there's going out with friends, there's books. And the guy with the athletic scholarship says, yeah, but my scholarship doesn't cover all that. I may need to take out loans. So you see the circumstances have changed again, but there's a lot of things to choose from if you know your way around getting support for your college education. Today, let's go over the summary. You've learned about secured and unsecured loans, the 4 C's of loan decisioning, about car loans and auto financing, and some ways to finance a college education. Hope these have been helpful for you, and thank you.